All right. Today is Sunday, November 12th, and this is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Before we begin, happy Veterans Day was yesterday, so we know a lot of veterans who watch this program and happen to be members of the channel, so thank you so much and happy to have you here. But folks, last week we talked about what was behind the pop, the rally, the rapid rally that took place pretty much in a couple of days and didn't allow anybody to get in. What was the catalyst behind that? If you listen to the media, the reason was, Mr. Powell came out in the FOMC and he said that he paused, and this time the pause is for real. This one is good. This is it. No more interest rate hikes. And therefore, we saw bond yields going down and equities going higher. And I told you back then, this is not what the man said. I played the video. He never said that. He left the door open that rates could go higher if the data merits. And we told you before that the Federal Reserve is not in charge, inflation is. And this is not by design, this is because of the Fed's own choosing. The Fed has been behind the game. The Fed decided to play this cowardly game instead of doing the job properly to tackle inflation down, as Chairman Volcker did in the late 70s, early 80s. This Federal Reserve, led by Chairman Powell, decided to play the game of, I want my cake and I want to eat it too. I created inflation by the reckless monetary policy. And instead of doing 180 to fix the mistake, the Fed wanted to play the game of, it's transitory, wait a little bit till the supply chain improves. We all knew that inflation, as Dr. Friedman taught us, has always been a monetary phenomenon. It's not about supply, it's not about demand. And then when the Fed finally realized that the inflation is not transitory, instead of doing the job aggressively raising interest rates 300 basis points in a single meeting, as Chairman Volcker did, to send a psychological message that the Fed is in charge, it will not allow inflation to get out of hand, this Federal Reserve decided to enter the fight with tiny little punches. 25 basis points here, 25 basis points there. And of course, inflation gathered momentum, said, you know what? Your punches don't matter to me. And we saw inflation getting out of hand. And then the Fed decided to play catch-up. And we saw inflation receding. But then the Fed decided to ease prematurely. And now we see that inflation is coming back again. Why did the Fed do that? Because God forbid if they do the job, the equities market will go down. And their sponsors and the oligarchy and the billionaires and the banksters will get upset. And this is why we say that the Federal Reserve is not in charge, inflation is. And this week, Mr. Powell came out and said, no, you guys got it wrong. If you're buying stocks with the assumption that, I said last week that this pause is for good and we have no interest rate hikes to come, you got it wrong. Mr. Powell said that he would not hesitate to raise rates again if necessary. So we now know that the excuse of, this is the pause for the millionth time is fugazi. It's bullshit. It's not the reason behind the rally in the equities market. The real reason behind it is positioning. We have some shorts who covered their shorts in bonds, and when they did that, bond yields went down. When bond yields went down, they triggered an algorithmic reaction of buying stocks. So we saw equities going higher. And as equities go higher, they hit certain triggers. For the quant funds, for example, moving above a certain moving average by design. The quant fund buys, and as the price rapidly goes higher, we see the market maker getting squeezed from the options. Lots of call options now become in the money all of a sudden, and the market maker has to buy. All of a sudden, you got three forces buying equities at the same time, with no seller, with no resistance at all. And of course, the last stage of any rally of this type is the capitulation by the retail mom-and-pop investors. They get in, and that marks the end of the pop. And perhaps we have seen this in Friday's session. In other words, the whole thing been a trap. We'll talk about this and a lot more, folks, but before we do that, let's cover our macro discussion for the night. We begin with a market maker, a billionaire known as Dickhead King Griffin from Citadel, and he came out with a really interesting commentary. Of course, the guy has a giant ego, and he's pissed off about his portrayal in this dumb money movie, and he's launching lawsuits. Dude, you're a billionaire. You won. If you have this much money, what do you care what people say about you? But anyhow, just so you know that all of these billionaires have no personality at all. But his commentary about inflation was really valuable. Mr. Griffin says that he sees high inflation lasting for decades. Whoops. We thought we have a soft landing here. We're done with the job, right? Inflation is gone and bond yields are going to go down. Interest rates will go down and you got to go buy equities, buy everything, splurge in the economy. Billionaire King Griffin, the head of the Miami-based hedge fund manager, said higher baseline inflation may go on for decades, caused by structural changes that are pushing the world toward deglobalization. Speaking at the Bloomberg Forum in Singapore Thursday, Griffin said that this will have an impact on the cost of funding the U.S. deficit. He added that the U.S. is spending on the government level like a drunken sailor, and that higher interest rates are something the government hadn't counted on. Adding, when we went on a spending spree, the country had more than $33 trillion in national debt as of September, and a fiscal deficit of almost $1.7 trillion for the fiscal year. Now look, we know that we have deglobalization, as Mr. Griffin says. That's inflationary because instead of relying on cheap labor from China, that's not going to happen anymore. Every country now becoming nationalist and realizing that manufacturing has to happen within your own borders, which means higher wages. Likewise, the development of AI, that's probably going to be inflationary because we're going to lose a lot of jobs and you're going to have universal-based income. Otherwise, we'll see revolutions and disasters in the streets. And that's inflationary. Not to mention, of course, climate change, which is reducing crops across the world. And of course, the lunacy of addressing climate change by the so-called green agenda. All of this rush in demand to build EVs while the resources are not widely available. That's inflationary. Oil-producing countries, they see what's going on and they realize that if they keep the supply as it is, they'll go bust. So out of their national interest, they're reducing supplies. And that's inflationary. And these dynamics, folks, many more, not just these, many more, are inflationary. We have entered a higher inflation era. There is no doubt about it here. But we also know that the cure for inflation is really easy. If the Fed does the job and the fiscal policy cooperates, meaning if the Federal Reserve raises interest rates dramatically, as Chairman Volcker did, then that's going to force the fiscal policy to be responsible. Otherwise, they're going to blow up from the interest payment alone. But this cowardly Fed would not do the job properly. And this is why we continue to see these inflationary pressures not just holding in the economy, but becoming widespread. The phenomenon of wage inflation, for example, is an illustration of how widespread and embedded inflation is in the economy. And the phenomenon of wage inflation leads to higher inflation overall in the economy. And that's irreversible, folks. You're not going to give employees a raise and then take it back. It doesn't happen that way. And this is why we are in an era of higher inflation. We talked about the UAW, and we talked before that about Las Vegas. And I said to the culinary union, you want to strike when the time is right. When we have this dumb F1 race that's going on in Vegas next week, that's the time when you threaten to strike. The casino companies will go down on their knees and give you a great deal. And guess what? The union was listening to the Maverick of Wall Street, and they threatened to strike just before the F1 race, and now they got a really decent deal. That's inflationary. That is a huge increase in wages, and it's not going to be reversed anytime soon. And oh, by the way, for all of you who are coming to town next week for the F1 race, tickets are going down now. They destroyed the city for one stupid event, and now all of a sudden the demand is going down. And oh, by the way, it's going to rain the day before, so that's not going to be nice. And oh, by the way, folks did not realize that Las Vegas also gets cold. And it's going to be chilly and really cold while you freeze your balls outside watching a bunch of stupid cars racing, and then they go away. You wait for another hour, then they come back. You jump off your seats. Then they go again, you wait for another hour. You know the deal. It's dumb. And it should be the last time we host this stupid event ever again in this city. But, you see, since the Fed did not do the job properly, and they decided to go with this gradual increase of interest rates little by little by little, and then holding interest rates higher and hope that the job will be done. The question now becomes, did this approach damage the economy more than it damaged inflation? What do I mean by that? We keep getting weak data about the economy. We see deterioration in the pace of economic activity, but we're not seeing a huge hit in inflation. Inflation went down and it's stuck there. This is why they call it sticky inflation. And now it's moving higher again. Example, this Friday we got the data from the University of Michigan. And as you can see, that consumer confidence, actually went down 65.7. The estimate was 70.3. But most importantly, 1 year inflation expectations was at 4.4%. The estimate was 4%. The previous reading was 4.2%. The 5 to 10 year inflation expectations at 3.2%, above the estimate of 3%. This was shocking. Why? Because we see consumer sentiment dropping to a 6-month low, while at the same time we see the 5 to 10 year inflation expectations reaching a 12-year high. Does this look like progress to you? Does this look like mission accomplished to you and it's over? Or is there a massive dildo about to come here into the picture? And nobody's prepared for that. And what could that dildo be? The answer is, how about the next CPI report? What if that comes out hot? Then all of these assumptions will be scrambled rapidly. We will see a sizable reaction in the stock market. Because if the CPI comes out hot this week, then Mr. Powell, aka close the fucking door, or he has to open the door wide open for more and more interest rate hikes, which means that yields will go higher and we will see a violent reaction and an adjustment to what we've seen last week, followed up, of course, with more insanity this week. When we talk about whether the Fed's policy and approach so far did more damage to the economy than inflation, just look at some of the data that we got this week. The average credit card balance right now tops $6,000, a 10-year high. We see delinquencies rising. And of course, the younger generation, the millennials, are the ones driving the increase. Credit card debt hits a record $1.08 trillion. The older generation, the oligarchy and the likes, they're having a good time in this economy. But the younger generation are suffering. Owning a home is a fantasy right now for the majority of millennials and Gen Zers. It's impossible. Bidenomics, you say? Is this Bidenomics? Are you proud of this? And oh, by the way, delinquencies are now surging higher. If you look at the year-on-year increase in the rate of delinquencies, it is consistent with recessions that we have seen in 2001, 2007 to 2009. So again, when you hear the bullshit in the media that this is Bidenomics, everything's working fine, inflation is going down, we have the Goldilocks scenario, the soft landing, the golden path, all of these bullshit terminologies. In reality, what we see right now is eerily similar to previous disasters, not good economic times. Moreover, we read the headlines that Americans continue to ransack their retirement savings. Bidenomics, you say. The ravaging of retirement accounts is on a roll. The number of participants taking hardship withdrawals from their 401k was up 13% in the third quarter versus the second quarter, according to Bank of America, which tracks 4 million clients' employee benefit programs. The tallies up to more than 18,000 plan participants, the highest level in the past 5 quarters since BofA started tracking this data, and up 27% compared to the number of withdrawals during the first 3 months of the year. So when you have consumers getting squeezed like this, with credit card debt moving higher, with delinquencies moving higher, with home affordability becoming pretty much impossible, automobile affordability becoming almost impossible, with the average monthly payment exceeding $600 per month, when you have folks taking money out of their 401k out of desperation, isn't all of this a sign of a consumer getting choked by this economy, with higher interest rates from one side and inflation that refuses to go down, despite the increase in interest rates, because they're not enough and they were not done rapidly. In the beginning, when they should have done it to play the psychology, they missed that window. And now it appears that we have a stagflationary phenomenon in the economy. Consumer sentiment down, inflation expectations higher, inflation creeping back up, the pace of economic activity crashing down. The pace of job creation is now also slowing down dramatically. We see that the unemployment rate moving ever so slightly higher. And this is just the beginning. Before we see 4% unemployment, before we see 4.5%, 5%, 6%. And if the American public is looking for any relief from higher interest rates, forget about it. Forget about it. You know why? It's not just because inflation is going higher, which will force the Fed to raise rates higher despite what they say, because they're not in charge. It's also the dynamic that we talked about. The insane fiscal policy, the insane deficit that we have that King Griffin was talking about, that's causing a tsunami of supply of bonds. That reduces the price of bonds and increases the rate in these bonds. And that drives the interest rate policy in the economy. The interest rate that you pay for your auto loan, on your credit card, on your mortgage, that is driven by the increase of interest rates on U.S. bonds. And as they continue to increase the supply, because that's the only remedy they have right now to fund all of these wars, all of this insane spending that we see, Either they have to raise the taxes by 90% or they keep issuing bonds. In the past, the Fed was buying all of these bonds and the Ponzi scheme was going, nobody was paying attention. Now the Fed can't buy all of these bonds because they have quantitative tightening. They have inflation going on in the economy. So we have to rely on foreign buyers. And foreign buyers are saying no thanks. Your fiscal house is in a mess. We demand higher rates. Number one. Number two, we see the behavior of our government. You and I think that this country is looked at overseas as the shining city on the hill. In reality, the world looks at us as the big bully. Sanctions here, sanctions there, wars here, wars there, threatening, intimidating. Nobody wants to fund this policy anymore. The world is looking for an alternative. Not just for the dollar, but for U.S. debt too. And this is why this week, and I told my viewers when this happened, the 30-year bond auction was perhaps the worst auction I've ever seen in my life. And it's not just me saying that. You can listen to Jurassic Park, Art Cashin. He was trading stocks and watching bond markets since 2000 BC. You listen to what he has to say.
On the CNBC Newsline, UBS's Art Cashin. Art, talk about the data that's coming next week in a minute, but I do wonder whether or not you think yesterday's auction was historic or pivotal in terms of near-term market direction.
Well, it certainly was something that got everyone's attention. You know, it was not just a poor auction. It was absolutely lousy. And you know, when the dealers have to step in to save a treasury auction, that's a rare occurrence. And
so you understand what happened here. The foreign buyers said, no thanks, we're not buying the shitty auction. Goodbye. The dealers were forced to buy these bonds. Otherwise, this auction would have been an absolute disaster. And it was, even with the forced buying. No wonder why, ladies and gentlemen, Friday evening, when the market was closed, when all of you capitulated and you bought the stock market because you got FOMO and you fell into the trap, they came out with Moody's cut. Moody now cutting the outlook of U.S. credit rating to negative from stable. Well deserved. They should have cut us to junk. Would this be a wake-up call for the gaslighting regime in this country? Of course not. They came out and said, oh, Moody, they have no credibility. Really? Moody has no credibility. Or is it you who don't have any credibility anymore? To the point where foreign buyers refuse to buy your debt, which is supposed to be the easiest trade in history, the safest trade in history to buy U.S. bonds. You're gonna get paid back. Now foreign buyers say, no, I'm not sure about that. I demand higher rates to hold you shit debt, which means the rates are going higher, which means that you're going to pay more, which means that the consumer purchasing power will get annihilated in this economy. How are we going to drive corporate earnings from a consumer that will get annihilated? Can we justify the stock market rally? Can we justify the insane multiples in this stock market? Of course not. But it's a game, and the game will end in tears. They're not going to make it so obvious for you. And for that, let's move on and cover the market discussion, folks. Let's begin with this. We often talk about the three drivers of the stock market: the technicals, the fundamentals, and the mechanics. And you can rearrange the order however you want. You know why? Because in certain phases, the market is driven by the mechanics, as we see right now. Most of the time it is driven by the technicals, and sometimes it is driven by the fundamentals. So the hierarchy of these three factors changes over time from phase to phase. We know that in the market that we have right now, we are driven by the mechanics, then the technicals, then the fundamentals. What do we mean by the mechanics? We talked about in late October, we have seen a surge in covering bond shorts. And with that also, we've seen a lot of managers covering their S&P futures shorts, and that's going to cause equities to go higher. When the shorts cover, they buy. So they're closing their net bearish bets against the S&P 500. As the charts climb above the 20 moving average and the 100 moving average and the 50 moving average, we see the algorithms, the quant funds buying. As we get to options expiration Fridays, the market maker will get squeezed because they have all of these calls that are now in the money, and they have to buy the underlying equities to hedge for these calls that are now out of the money but could be in the money by the close. And on Friday's session, if you look at the unusual activities that took place, the highest volume came from calls, all of them, on the SPY, the Qs, billions and billions of dollars of buying zero DTE calls, which forced the gamma squeeze, and the market maker decided to buy on Friday in a big way. And of course, a lot of us retail investors, we also capitulated and bought on Friday. Why? Because we are driven to make mistakes in mechanical markets. Why? Because as traders and investors, the majority of us, we follow the technicals. And this is why we're prone to do mistakes when the market is driven by the mechanics. We often see, in this case, a major squeeze. Some of us chase it at the wrong time because we see a technical breakout, as we've seen on Friday. If you just follow the technicals, Friday's breakout was a buy. 100% from a technical standpoint, but because it was driven by the mechanics, that increases the chance of it being a trap. Likewise, because us traders and investors are driven by the technicals, we see a huge pop like this and we see overbought conditions in the charts, we tend to say, okay, let's short this here. It's due for a pullback. And then now we realize that the move keeps going higher and higher and higher, defying the technicals. Why? Because it's driven by the mechanics, not the technicals. Examples. This is the weekly chart of Microsoft. We see a huge divergence outside of the upper Bollinger Bands. In a technically sound market, we don't see these kind of things. You can go back in this chart all you want. You will not find a technical violation like this until you go back to 07, when we saw Microsoft popping out of the Bollinger Bands, as we see right now, and that was the top right there and then. And then we saw the stock crashing. Oh, we got the crash of 2008, 2009. Likewise, this is a post from Sven, and he shows you that in the chart of NVIDIA, there was a classic technical head and shoulder pattern, topping head and shoulder pattern. We even crossed below the 400 line. Next thing you know, the chart does the opposite. Why? Because it's driven by the mechanics now, not the technicals. So the technicals take the back seat and the mechanics are in the driver's seat right now. And this is why we are prone to do a lot of mistakes in these mechanical markets. And by the way, is this guy getting a little too annoying, right? Because we know he's a perma bear, but now all of a sudden he's, hey, look at me, I'm bullish. Did you know that I'm bullish now? I'm so bullish right now. Look at me, I'm bullish. I guess we have the next Savita Subramanian, right? She was bearish all along, and then in June, she capitulated and said she is the most bullish she's been ever. And then a month later, we got the July top. You gotta be careful here. You flip-flop, now all of a sudden you're bullish, then something breaks. You know, the thing that we've been talking about all along, that with higher interest rates, something is gonna break in the economy. What if something breaks next week? Are we flush down big? What are you gonna say then? Hey folks, I'm sorry. Did I flip from bearish to bullish? Hey, I'm bearish again. How about you have a stance? You can trade the market. We're all going to trade the market the way it is. But how about you stick to a stance? Especially when the fundamentals are on your side. Speaking of, the fundamentals right now, they come at number 3. They'll be at number 1 at some point, but right now, the fundamentals are not the main driver of the stock market. Why? What is the evidence here? If we look at corporate earnings, when we look at profit warnings, they're increasing, and we're not even halfway through when we talk about corporate earnings. If we have such a sound economy, why would they warn about profits? They see that higher interest rates are now hitting the consumer really hard. In other words, demand goes down, but they're not really hitting inflation so hard, so the cost is still too high. You combine both of them, consumer demand weakening while the cost is still too high. Now your margins are going down, and therefore we see a lot of profit warnings. Furthermore, during earnings calls this season, we have heard weak demand mentioned more than ever before. Managers are now talking about weak demand, not just here, but across the Atlantic and Europe. Gee, is this really a good environment for the stock market? Is this really a good environment for the economy when you have companies telling you we're seeing weak demand? But folks, we know that this whole thing is based on 7 stocks. The so-called Magnificent 7. Without those, the stock market should be down 20% this year. But because of 7 stocks that are lumped into the AI mania, we see the stock market holding and moving higher. We look at the PE ratios for these Magnificent 7. We're above 30 times. Okay, but maybe these companies are producing huge profits, while we see other companies warning about profits. Maybe that's why they deserve the extra premium. Well, you'd be wrong, because the gap, the advantage that these companies had over other companies in the S&P when it comes to net income is shrinking and getting down to 0, meaning they had advantage in Q1, Q2, Q3, where the advantage peaked. And from this point on, it's sliding down. Now, why would I pay over 30 times earnings for these stocks when I know that their profits are going down? And maybe other companies, other value companies, we see their profits improving. Does it make sense at all? But we're all programmed that all what matters is Apple, Microsoft, Tesla, Google, Meta, NVIDIA. And that's keeping the NASDAQ higher. But if you look at the NASDAQ advance to decline versus the actual NASDAQ, this is the widest gap that we have ever seen. In other words, what does this mean? It means in reality, you take these 7 stocks out, the NASDAQ is crashing. So the entirety of the stock market is relying on 7 stocks, and by the way, they're now 6, because Tesla's gone. But anyhow, now you know that we're not being driven by the fundamentals or the technicals in this stock market, at least for now. We're being driven by the mechanics. options. The interesting thing about mechanics is they have an expiration date. Options expire, the mechanical element is gone. No more moving averages to pass above to trigger buying, and the shorts will be done covering at some point. Maybe they're already done covering. And the last buyer, the Johnny-come-lately, is the retail mom and pop. And then what do you know? The market shifts into being technical again. And oh my God, the technicals, the RSI all over the place are becoming really overbought. Or the market reverts into being fundamental again. And we get a nasty CPI report. And oh my God, now we have to undo a lot of the insane surge that we've done in the last 2 weeks. You look at the chart of the Qs, for example, the NASDAQ weekly chart. We have a descending channel of trading with clear, defined upper boundary and lower boundary. We did a false break in the month of October. How do we know it's a false break? Well, we know right now because we got a rip-your-face pop after that. But the break below the line was, technically speaking, a permission to short, that the market is broken. But because the market is driven by the mechanics right now, not the technicals, that was a trap. It was a bear trap. Now we have a break above the channel, which technically says you should be buying right now. But because the market is driven by the mechanics, not the technicals, what if it is a false break again? You see, when we look at the sentiment indicators, this is the most stunning sentiment reversion I've ever seen. You go in the week ending November 1st. Over 50% of participants were saying that in the next 6 months, the market would be bearish. Fast forward a week later, now we're talking about almost 43% saying that the market in the next 6 months would be bullish. How do you change this sentiment really fast like this? It's an illustration of the confusion that investors are just following whatever they see. They see the market down, they become bearish. They see the market up, they become bullish. But this insane flip within a week, that's an illustration that we have an anomaly. And this anomaly is because of the market becoming mechanical, not technical or fundamental in nature. And unfortunately, comes Friday, end of the week, never really got a decent pullback as we anticipated last week. We see the retail mom and pops capitulating and buying a lot of call options. Could this be the mistake on the upside as it's been on the downside? You see, in the month of October, when the stock market appeared to be crashing, here's the headline. Individual investors pulled most cash from U.S. stocks in 2 years. In other words, the retail mom and pops, they freaked out. They gave them a drop in October. We freaked out. We got out of the market. They flushed us out. Then they create a pump and they want us to be back now. Is it yet another trap? Because once we got out, they pumped the market higher. Now we chase, they drop it down. Retail traders sold nearly $16 billion in stocks last month, nearly twice what they unloaded in December. According to S&P Global Market Intelligence, they dumped shares in nearly every sector, although they increased exposure to real estate, which is the second worst performer in the S&P 500 index this year, with an 8.3% decline. The sell-off reveals fading enthusiasm from day traders who had been chasing the upside in the market's unexpected rally at the start of the year. While the S&P 500 is up 13% this year, it lost 5% since the start of August, as investors come to grips with the Fed keeping interest rates higher for longer, while geopolitical risks are mounting. And listen to this, prior to the last couple of months, they would have been the first group that would come to mind to buy the dip to take advantage of a pullback. We see it as more of a turning point for some of the longer-term macro trends behind retail investing. In other words, the anticipation was you get a dip, the retail mom and pops would buy. But in October, it keeps dipping, they buy, they get smacked in the face. And then finally, retail investors said, okay, we got it, goodbye. We're done, we're out. You scared us. We're gone out of the market now. And even institutional investors, they sold fewer shares in October than in September, but were still net sellers of equities. The monthly total was $19 billion of sales, beneath the 12-month average of $21 billion. So who created all of this trap? Flushed away the retail and the institutional investor, and then they create a rally. They make the money. They frustrate us. Waiting for a pullback. Pullback doesn't happen. We capitulate, we buy at the end of the rally, and then they flush us down. If you said the hedgies, you got it right. Meanwhile, the hedge funds increased their exposure to U.S. stocks. That's in October, baby. When you and I were selling, they were buying. Blake noted that the group appeared to be buying into weakness in equities. Uh-oh. Classic trap, folks. And now, since we have the pump, guess what? The managers, the institutionals, they capitulated and they bought. You and I, the retail investors, we capitulated and we bought. And let's be honest, we did that Friday. At the top, exactly, because that's what we do as retail investors. We're dumb as rocks. We have FOMO, and guess what the hedges are doing right now? Hedge funds sold U.S. financial stocks at the fastest pace in 7 weeks, driven by short sales. The sector long-short ratio ended the week at the lowest level in our record, according to Goldman Sachs. Well, gee, if they're shorting financials, aren't they betting on the systemic risk scenario? Aren't they betting on an interest rate-driven risk? And how could they be bullish equities? And next thing you know, Friday, we get the downgrade by Moody, and the rest is history. Do you understand now that all of this emotional sentiment that we see in Twitter and on Discord, oh, we're missing out. Can you stop being stupid for a minute here and understand what's going on? The whole thing is a game. And sometimes when the market looks hard, it's hard for a reason. It's telling you to stay the fuck out. Close the fucking door. You don't have to trade every day. This is a mechanical market. Wait till it becomes technical. Wait till it becomes fundamental again. Then it becomes easier to trade. But mechanical market, we're prone to do mistakes in them. And all it takes is one mistake to erase the entirety of your gains that you made for the year. You do so good, and you get caught in one trap. Boom, the whole thing is over. What is the point here? But folks, let's expand the conversation a little more and cover the market information from the session on Friday. We begin with the closing of the indices, and here we go. The diamonds closing in the green by 391.16 points, or a gain of 1.15%. The Nasdaq leading the pack in the green with 276.66 points, or a gain of 2.05%. S&P 500 also positive by 67.89 points, or a gain of 1.56%. Even the Russell 2000 managed to participate in the rally on Friday. Why? Because it's mechanical. It pumps everything higher. So we see even the Russell up by 1.87 points, or a gain of 1.12%. In a mechanical squeeze, when we look at the sectors, all positive on Friday's session, led by technology, the big seven, of course. But if you look at defensives, utilities, financials, energy, all positive, nothing to see here. Yet when we contrast the daily with the weekly performances, what do we see here? Whoops. Impressive market rally, isn't it? Led by 2 sectors, aka 6 stocks, because Tesla's dead now. Technology, comm services, some of the industrials, the GE and Boeings of the world. But the rest of the market is down. Energy, utilities, real estate, metals, healthcare, financials, defensive, cyclicals, all down. Yet another warning sign not to chase. We look at the breadth on Friday, pretty good in the NYSE, 73% advancing versus 25% declining. When we look at the Nasdaq, again, it explains the huge divergence between the actual Nasdaq and the advanced to decline ratio. The breadth has been absolutely horrific in the Nasdaq, and Friday is no exception. 57% advancing versus 40% declining. We move on to commodities on Friday. What do we see here? Nice rebound for crude oil, but we talked about it beforehand, that it's going to be because of the technicals we got outside of the Bollinger Bands, we're going to get a rebound. But it could be not sustainable here, because oil has one tailwind left. And that tailwind is the geopolitics, the war in the Middle East. So far, we haven't seen an oil embargo. So far, we haven't seen the involvement of other parties in the war. It remains a very dangerous war, and all possibilities are open. But the headwind is extremely strong right now, which is the slowdown in the pace of economic activity here and in China. And unless you have a flare-up in the geopolitics, it's really hard to have a sustained rally here in crude oil. Now, when it comes to metals, we also talked about how the dollar is moving higher, which is not good for metals. So you look at copper, you look at platinum, you look at palladium, they're all down. But we have seen precious metals, gold and silver, defying this correlation and actually moving higher in the past few weeks. Why? As a hedge for the geopolitics for the most part, but also a hedge for what's going on in the bond market. And now that we see that the geopolitics is not really moving from the low risk scenario that we talked about into the mid risk scenario, which means an involvement of another party or an oil embargo, we haven't seen that yet. So now we see a lot of traders, a lot of investors saying, you know what, let's take some of these hedges out of gold and silver for now. Let's free up some cash so we can chase the rally in equities, buy at the top, and lose there instead. When we look at the weekly performances all in all, we see that OJ's back on top again. It dropped last week. Now it's coming back with gains north of 7%. The laggards, led by palladium, natural gas, not a good week for natural gas. But for now, we're maintaining a pattern of higher lows. So watch out. We could see a rebound coming here. On to the big casino, the options market on Friday. What do we see here? The volume, believe it or not, is still anemic. So we're not seeing a lot of participation here, a lot of capitulation from the retail mom and pops. We see them buying some calls So whatever trades we have, they're mostly calls, not puts. So we see the ratios in the high 50s for calls, in certain names even in the 70s, which is also a sign that things are getting a little too excessive here, and you're probably going to see the opposite reaction. We have seen the option volume increasing in Tesla, Nvidia, and Apple on Friday's session. Tesla is the most interesting one for me because it's been the laggard. And if you're looking for a catch-up trade, suppose that you believe this mechanical rally will continue, maybe at least until Monday until we get the CPI Tuesday. What do you do at that point? Do you chase the same names? Do you chase Microsoft, Apple, Meta, Nvidia? All of them are severely overbought now, not just on the hourly hour side, but on the daily hour size too. So that would be the high risk. If you chase the momentum, that is the highest risk because the moment you chase, they could go down right away. The mid-risk chase would be in the IWM because it did correct. It went down and took a lot of the fluff. So if you believe that the rally will continue, maybe there is a catch-up trade in the IWM. And also Tesla. Why Tesla did not participate in this rally? So if we see the retail mom and pops capitulating and saying, okay, I'm going to chase the rally now, what would they chase really? What is the name, the number one name the retail mom and pops love to chase? That would be Tesla. So Tesla could be a catch-up trade for Monday if the market opens positive. Of course, we have the Moody's downgrade. We have the CPI Tuesday. So that could be not a guarantee here. Now, the low risk chase is if you look at names that went down big for silly reasons, such as the Ozempic mania, for example. Names that are really oversold but appear to be bottoming, and they're good company. Then buying those would be the low risk scenario. And we have a lot of names. We talked about them, folks. We talked about Boeing. We talked about a lot of names in the consumer staples. I recently bought McDonald's, for example. Those are low risk because you buy them, you're going to hold them for a long time here. You're not really chasing, but if you believe that the market is going higher, and these will be the low risk chase here. Names that went down big, but they're solid companies. They became oversold, and now we see opportunities in them. So not the entirety of the market is bad, folks. You just have to look for good opportunities here. You want to chase? That's up to you. But chasing is a fool's errand because the moment you chase, you're probably going to chase late in the game. Then they flush it down in your head later on. So just a few ideas here. Hope that was helpful for you. And if we look at the 5 days put to call ratio, this is the 5-day average. So we talked on Friday that we saw a lot of call options buying, a huge increase, an illustration of chasing. But believe it or not, the 5 days average, folks been buying puts, not calls. In other words, the majority of folks been skeptical about this rally and betting for it to go down until Friday. Friday when we saw the capitulation and the buying of calls. Just keep that in mind, that the majority of retail remains skeptical about this pop. On to the unusual activities that took place in the options market on Friday. What do we see here? Not a lot of activities, believe it or not. They're not betting a lot, which tells us once again that the retail mom and pops are not really participating. They're watching. Maybe they're stuck in certain positions, but they're not really participating in a big way. So here we have FL for Foot Locker. Somebody sees the name moving higher. They bought the 22.5 calls for the expiration date, December 15th. Expectations, the name will pop higher by more than 10% by then. Paid about $1.20 a piece. Standard. This trade, all in all, spending about $1 million. How about the ticker ARM for ARM Holdings? The options are available now and somebody's betting for the downside here. They bought the 44 puts. This is really interesting because it's a big bet here. Not on the dollar amount, but on the degree of the move. Expectations are that ARM Holdings will go down by more than 16% by the expiration date, December 29th. Paid about 50 cents a piece. Standard. This trade, all in all, spending about $350,000. Last but not least, if you want to chase, and you want to chase the momentum, Apple, Microsoft, Meta, maybe the safest way to do is via call options. So here we have a trader who's obviously chasing, and they bought the 200 calls for Apple. Expiration date, December 29th. Expectations that Apple will rally higher by more than 7% by then. They paid about 75 cents a piece. Standard. This trade, all in all, spending about $400,000. On to the heat map. This is from Friday. A sea of green, mechanical rally. Gamma squeeze, everything gets bought. Banks doing good, industrials doing good, even energy, metals, cyclicals, all participating. But the majority of the buying, folks, came from the big caps, Microsoft, Apple, Nvidia, Google, Meta, Amazon, even Tesla participated on Friday. And this is why I say if you want to chase, maybe Tesla's a better choice here. That the retail mom and pops will capitulate and buy Tesla, we'll see. Chips, big move because of Taiwan, TSM. So we saw a lot of buying in chips on Friday, a lot of buying in software, despite the fact that TTD Trade Desk was a disaster. The name dropped by more than 30% after reporting. The losses were minimized as a lot of folks bought the dip in TTD, excuse me. A lot of them are betting for closing the gap, that we will see a full recovery in TTD. I disagree, especially now that Kramer says it's a good buy. But folks, look at this. When we contrast Friday with the weekly heat map, what do we see here? The picture is obvious and it's clear. The rally is led by a handful of names. The usual suspects, the big seven, only this time around ex-Tesla. So Tesla was down almost 2.5% for the week, but we see the big six now. Forget about the seven. The big six are up for the week. The majority of the flow is coming on the big six. The chip names that come with them, the AI mania, Oracle, Adobe, AMD, some of the software names, and of course the Ozempic mania and Eli Lilly and NVO and healthcare. Besides that, we have seen some earnings plays, but the majority of the market was down. And it tells us that the breadth is not good, and we see a lot of chasing here in the same names. This is not a good way to seduce us, let's say long-term investors, to say that this is a healthy market that is recovering right now or bond yields are topping and we should be buying because it's the same names being popped again. It's the same bubble. Now, the contrast that I find really interesting is in banks. So you see the Bank of America is down, Wells Fargo down, the majority of them are down. But then we see JP Morgan up about 2.5%. In other words, if there was a manager who capitulated and bought financials, they decided to go with the strong JPM, not the weak. So the hedge funds are shorting all of these banks now. But we see JPM outperforming. In other words, even when we see dumping of these stocks, investors are also being mindful that when you have a company that is doing good in the fundamentals, and I would say that JP Morgan is not immune from the risk that will face all the banks, the risk of higher rates and slowing down of the economy. But JPM is doing better. So when you're a money manager and you have to allocate money into financials because due to positioning, you just have to. You have to buy some financials. As a manager, you'd say, okay, if I must buy banks, I'm going to go with the strong. And the strong is JPM. So again, if you're going to buy dips here in any sector, you got to look at the strong and avoid the weak. And the reason is if we have positioning, let's say for the end of the year or for 24, the managers will have to hold their nose and buy these weaker sectors. But they will buy the strongest names in these weaker sectors. Anyhow, moving on to the heat map for the week for the ETFs, what do we see here? Right off the gate, we see that the TLT is slightly positive. So it's not strongly positive. And therefore, we see any of these yield-sensitive ETFs, XLU Utilities, IYR Real Estate, KRE Regional Banks, the XBI Biotech, we see them down big. In other words, these sectors require a huge pop in bonds in the TLT, huge drop in bond yields. But certain sectors, at least this week, maybe due to earnings from D.R. Horton, we see the XHB, ITB, XHB's Home Builders, ITB Construction. We see them holding a little better since yields all in all were negative for the week, be it ever so slightly. Energy down, and the reaction tells us that the economy is probably heading into a recession. We see gold down, we see gold miners down, and that's due to the unwinding of geopolitical hedging. What's up for the week? Again, it's the usual suspects. It's the XLK technology, the SMH, chips. And if you look at large cap growth, IWF, VUG, those were up. Value, VTV, IWD were down. Mid caps, MDY, IGH were down. Small caps were down. IWM, IJR. Any legitimate rebound, any legitimate end of a bear market or a bear trend should be led by the IWM. If it's not, there's a high degree that it is a trap. And the IWM has been the laggard this week, down over 3%. And I don't see this as a good sign, folks. But anyhow, let's do the charts and see if they offer us anything new or not. Bear in mind that the technicals right now are not the most important thing. They will become really important, but maybe not right now. We'll see if this upcoming week makes them more important than the mechanics or not. We begin with the SPY and hourly chart here for the S&P 500. What do we see here? We were waiting for a dip. We were waiting for a legitimate pullback last week. The rally was excessive. You look at the RSI, the hourly, it was really hot. We were waiting for a legitimate pullback, maybe closing one gap, maybe the gap below, and then that would give us a better buying opportunity. But of course, in the market, seldom that things go according to expectations, and the expectations by buyers on the sidelines were, let's wait for a legitimate dip here. What do we see? We get a little tiny dip, did not even close the gap. And that was when the 30-year bond auction bombed and the commentary by Powell followed, indicating that he's not done with raising rates. And then came Friday, we got the mechanical squeeze, and the equities market went higher, and we saw a lot of capitulation at the end, forming what it appears to be a rising wedge, which is at the risk of pulling back. With that being said, we have seen this look before, and we got another gap higher. So what do we do here? Since the technicals are not really that important, we need to wait for the market feedback. When you see a breakout like this, you need to have some exposure to the upside, just because the technicals say so. But you also have to have some exposure to the downside in case it is a trap, and in case we see the market reverting back into technicals from mechanics, and we see an adjustment. We talked about this in Discord on Friday, that perhaps an idea would be being long the SPXL, buying some calls there, but at the same time maybe buying some puts, or let's say the Qs or Microsoft. Maybe you buy calls in Tesla or calls in the IWM. And then you complement them with a put on, let's say, Apple or Microsoft or Meta or the Qs or anything that went really too high in the last couple of weeks. And that way you have a balanced exposure as we head to next week, which will be really, really important, at least from the macro perspective, because we have the CPI. Here's the daily picture of the SPY. What we know for now is we have a closing above 440, which was a really important number. But we have also closed the gap, and that's again important. That's all bullish. The chart right now says you should be buying. The RSI is not really overbought. It has a little more room to go here before it becomes really overbought. Likewise, if we use a trend line here, we know that we have a downward trend, and we're reaching the same sloping line of resistance right now. So this could be a point where we stop. That's the risk. On the other hand, do you just assume this risk that we are here at the sloping line of resistance, so the chart must stop at this point? Not really, because if you look at the pattern all in all, we now have a higher high. And even if the sloping lines stop us here, we're looking for a higher low. So we might get the pullback right now, after a lot of folks capitulated and said, okay, the pullback is not going to happen, I must chase right now. And now that we're at the sloping line of resistance, we pulled back, forming a higher low, which is still bullish, folks. It's not bearish from a technical standpoint. Now, suppose we're not going to stop at the sloping line of resistance here, and we go a little higher. How far can we go? If we look at the yellow line, that's the 100 days moving average. We're above, so we have no resistance here from any moving averages anymore. What do we have? We have the top of the Bollinger Bands, and that could coincide with another line of resistance here at the level 444. And this is why I say you should at least have some bullish exposure until Monday. Then we close that as we get to the CPI, just in case the SPY wants to close all the way to 444. And then you have the bearish exposure that would cover you in the CPI and after the CPI. What about the SPX, the cash index, weekly chart? What do we see here? On the weekly chart, we have a break above the 20 weeks moving average, and we have a break above the sloping line of resistance. In other words, we have made a higher high. Bullish or bearish? Answer is bullish. We have the next stop at 4448.47. Now, does this mean that we're up for the races here and this is not a trap and higher we go to the moon? Not quite. If you look at the Vortex Index, I'm going to expand this for you. We now see that the bearish momentum, and this is a lagging indicator, by the way, just bear in mind, we see right now that the bearish momentum has stopped in the weekly chart and the bullish momentum also bottomed. And now what we're going to see is the blue line, aka the bullish momentum, will cross over the red line, aka the bearish momentum, giving us a confirmation that the chart indeed has turned bullish. The problem is, by the time we get this confirmation, we could see the market already pulling back. And what happens next could be, we see that the bearish momentum climbing back up and the bullish momentum going back down. That is a possibility. So this is why I say that this rebound is technically weak. It's not showing up with a lot of volume, and this is why it's not registering a really strong response in the MACD or the Vortex indicator on a weekly standpoint. If we look at the daily chart for the E-mini futures, what do we see here? And I'm keeping the white line, which is the 100 days moving average, because in the futures, we start pretty much exactly at the 100 days moving average. We do have resistance above from the top of the breakdown candle at 44.45, but if we stop here and pull back, it would not be out of the ordinary because we're now at the 100 days moving average. And we pulled back at this average before, so it could be the point of resistance here. But the chart, all in all, you look at the RSI, you look at the MACD indicator, you look at the Vortex, you look at the fact that we're above 43.84.5, all bullish right now. And we are also forming a pattern of higher highs, at least for now. We have no confirmation until we get above the 100 days moving average with comfort. But for now, the pattern is clear. The chart has made pretty much, it needs a confirmation, but we can give it a pass for now that it made a higher high, which means any pullback, we're waiting for a higher low, which is once again, folks, bullish, not bearish. Does that mean that we're going to rebound and go up to all-time highs? Not really. We can go down in a pullback and just consolidate there till the end of the year. Because the key for us to make lower lows in this chart, or any chart, is for the 10-year yield to go back above 5%. That's the only reason that the equities market will make a new low this year. What could be the catalyst for 5% in the 10-year could be the CPI. So that's the risk, folks. But for now, I think the lows are secure, absent of 10-year yield going above 5%. And of course, I don't think we make the highs again until we make sure that the 10-year yield will not reach 5% again. How do we know that? If the CPI comes out cool and we see another drop, a big one, in the 10-year yield. How about the Qs, the NASDAQ? What do we see here? Hourly chart. Once again, we were looking for a pullback last week, never got it. We got more gains. Comes Thursday, we got a little bit optimistic that we could go down to 367 at least, see how that's going to hold, and then maybe we'll get a better buying opportunity. But Friday, we got the mechanical squeeze, now perhaps forming a rising wedge. It's above 367. It is challenging 379.20, which is my next line. But we have seen this rising wedge look before, did not play out. So it doesn't mean that it's going to play out just because. We need to see it play out. We need to see it violating some support lines before we say that, okay, this rebound has tapped and now we're looking for a higher low. For now, the RSI is really overbought, so we are at the risk of this is pulling back aggressively. Now understand that when charts defy the technicals, the higher they go, the bigger the pullback once the market reverts back into being technical from mechanical. So that's the risk here. This is why I say that if you must chase anything here, maybe play the catch-up trade with the IWM, not chasing the Qs at this point. If we look at the daily chart for the Qs, what do we see here? Unlike the SPY, this is above the sloping line of resistance. The RSI has a little more room to go before becoming overbought. Likewise, the chart made a pattern of higher highs. So now we're looking for a higher low. Could it be a retest of the sloping line again? Perhaps. Could it be a retest in the, let's say, aggressive scenario to the 20 days moving average? That remains to be seen. We have to see the top first. And right now, the only thing that could stop the chart is, let's say, we have the top of the Bollinger Bands on the daily chart. On the weekly, we know that we're above the 20 weeks moving average, above the sloping line. But then we have the next stop that we have to challenge, and that will be at around 380.83. So that could be another point where this stops and begins to reverse and giving us the pullback. Now, if you look at the weekly chart, the bullish scenario is, what if this is a cup and handle formation and it is breaking out right now? Of course, the confirmation will be breaking above the last high, which we're not at right now. The bearish scenario still holds if we have, all in all, a lower high, if we never make it above the highs. And that's a long way to go from here. If we look at the daily chart for the NQ, the NASDAQ futures, what do we see here? We're above 15,500. The RSI is firming up. The MACD is firming up. The Vortex is firming up. The volume came out on Friday. We're making a pattern of higher highs. All of that is good. But there is a point where this pop stops. The reaction will face counter reaction. And the counter reaction right now, the assumption is we see a higher low. Whether that's 15,250 or 15,000 even, who knows? The point being is, if you want to buy the NQ right now, or the Qs for that matter, do you chase right now, or do you wait for that pullback? Well, the pullback didn't happen so far. So the psychology becomes FOMO. Oh, Maverick, if the pullback didn't happen, why would I wait for it? What if this goes back to all-time highs in one shot? Okay, so what do you do here? You buy a little bit. So you buy one increment. If you pass another high, then you buy another increment. Otherwise, if you get the pullback at last, then you can have the second increment in. And you're going to buy at a lower price, which assumably will be at a higher low. And then the chart recovers and goes higher again. But trust me, once we get the pullback, we're going to get it for the wrong reasons. Because bond yields went higher again, where the CPI came out ugly. And at that point, would you really continue to buy the dip? Would you really buy that second increment? I doubt it. I think the psychology will change 180 degrees the moment we get a pullback here. But I understand the FOMO, and this is why I say if you must chase, please do via increments. Likewise, when we look at the IWM, the Russell 2000 daily chart, what do we see here? What we see is we have a pullback, unlike the SPY and the Qs. In this chart, we got a decent pullback. It filled one gap, and it almost filled the other gap below. If we see a rebound, this could be a catch-up trade. In other words, this could be maybe a bull flag pattern. It is above the 20 days moving average, and it is above 169. So the case for buying this is a lot safer than chasing the Qs or the SPY. It also could be a pattern of an ABC breakout. When do we say that, okay, this is not an ABC, forget about it? If we lose the 20 days moving average again, and if we go down to the gap and close below the gap, then not only are we going to lose the ABC pattern or the bull flag, we're also going to lose the potential of an inverse head and shoulder mold or pattern. Now, the downside risk for the IWM, if we look at the weekly chart, if you go to the program 2 weeks ago, I said that once the IWM goes down, outside of the lower Bollinger Bands, we're going to get a reaction. And we got this reaction. It was a huge reaction. We played it in this channel by the TNA. We got TNA calls, which is the 3-time levered index for the IWM, and it played out pretty good. Now we get a pullback. Was the pop just because of a technical correction here, and then down we go from this point, or is this the beginning of a bottoming process, and higher we go from here? Well, the line in the sand becomes 176.42. If we crack above it again and close above it from a weekly standpoint, then that will be a confirmation that we have a bottom for the IWM, at least for the year. But if we never make it above there, or we continue to slide down, then understand the risk is for making lower lows in the IWM. How about the dollar, the Dixie? What do we see here? On the daily chart, we're short of the 20 days moving average. And the consensus for now is, despite the rebound, this could be a formation of an inverse ABC pattern, and the dollar breaks down. And if it does, that would be good for the equities market. But if we zoom in to an hourly chart, we still have an upward trend in this rebound, and there is a threat that the dollar could make a recovery. So we're not out of the woods here when it comes to the dollar. If the dollar moves higher, it will be because of a hotter CPI and more expectations of Fed tightening and reducing the money supply, and that would be bad for the equities market. If we look at the old man gold daily chart, what do we see here? It got to my number, 1933, and I say to anybody who wants to buy gold, we gotta see a rebound here. We gotta see a confirmation. So 1933 is good, but the confirmation will be closing above 1962.58. Absent of that, I'm not interested in chasing here, because if we break 1933, then we will see a lot of capitulation. A lot of folks who hedged by buying gold because of the geopolitics. They will begin to unwind these hedges, rushing to the exit door at the same time. And then we're going to see the inverse correlation with the dollar becoming dominant. Likewise, if we look at the SLV silver, we are below the 20 days moving average. We got a rejection. Now we have a confirmation. You look at the RSI in negative divergence. You look at the MACD, also in negative momentum. So is the Vortex indicator. So we have more downside to come here in silver. And if we go down to 20.27 and that's broken as support, we're probably going to see another flush down here, as a lot of these hedges, because of geopolitics, will be taken out of the table here. And if the dollar moves higher above the 20 days moving average, that's going to be yet another catalyst to dump silver here. So if you've been waiting to buy the dip in the SLV, hold your horses. We have no signal here yet. When it comes to UK oil daily chart for Brent oil, what do we see here? In the last show, we talked about the overextension outside of the Bollinger Bands, this time around in the lower Bollinger Bands. Every time that happens, we see a rebound. So we were anticipating a rebound. We got the rebound. Do you chase the rebound right now? The answer is not quite. You gotta be really, really careful. Oil is not gonna be bullish until it cracks above 85 again. Likewise, when we look at the weekly chart for the XLE, this is for the ETF for oil stocks. Do you chase oil stocks right now? Too dangerous. We're below the 20 days moving average. We have a negative divergence on the RSI. We have negative momentum in the MACD. We're about to have a confirmation for bearish momentum in the Vortex indicator. All of them are leading for more downside to come. Once we have a reversal and a confirmation with the XLE closing above the 20 weeks moving average, then okay, you can buy them. Right now, I would say that it is a short, but you gotta be careful because of the geopolitics. Anything that flares up could pop oil higher again. So if you want to short the XLE, have some calls on the USO as a hedge. If you happen to be long oil stocks or long the XLE, you gotta have some hedge here by buying puts on the XLE, just in case we go down a little more. And then you have the luxury of assessing your positions individually. And if you don't like them, you can get rid of them, but without enduring the loss, because the puts will compensate you for that loss. How about the daily chart for the 2-year yield, which the Fed follows? We see it moving higher now, and I believe that if the CPI comes hot, it's going to pop and make a new high, and that would rattle the equities market. But for now, the equities market is more concerned about the 10 and the 30, not the 2. But even if we look at the 10, look at this. We're now closer to the breakout point at around 4.657 basis points. If the 10-year breaks above that point, we're going to see the algos reacting negatively in the equities market. Why? Because at that point, the risk of reaching 5% will be a reality. Once again, if we go below 4.483 basis points, then we could rally even more, because the risk of 5% becomes out of the picture at that point. And this is why the CPI this week will be decisive. But please understand that while inflation is a factor, We have another factor, which is the supply and the reckless fiscal policy and the budget deficit. We have a looming fight right now with the shutdown. That could push yields higher despite a weaker CPI. Furthermore, when we zoom into a 2-hour chart for the 10-year yield, what do we see here? Inverse head and shoulder. So you got to be careful with the TLT here. A lot of you love the TLT for some reason, weird reason that I really can't fathom. You got to be careful with the TLT here. At some point, it will be the trade to buy the TLT. But trust me, when the majority of folks, when everybody on Twitter says, oh, the TLT is the one, you got to buy the TLT right now. The recession is coming. It means it's not going to happen right now. When it happens, when everybody says, okay, yields are going higher, TLT is going to the dumps, we're back at 5%, we're going to be 7 now, then we're getting closer to a viable point in the TLT. So you got to be careful right now. If we look at the 30-year yield, what do we see here? Got a rebound off the really awful auction here, and it got us above the threshold at 4.727 basis points. In other words, this chart has turned positive. It bottomed in the bearish momentum. Look at the MACD indicator. You see those red columns? They're getting shorter. In other words, the bearish momentum has bottomed. This could go higher if the CPI comes out hotter. So the risk is real here that yields could pop higher again and equities will flush down big. Of course, when we look at yield-sensitive sectors, we look at the XHB home builders. On the daily chart, it looks pretty good right now. We have a bull flag pattern, got a pop on Friday. The momentum looks good in the RSI, looks pretty good in the MACD, looks pretty good in the Vortex indicator. What's not to like here? What's not to like is the charts that I just showed you right now. 30-year bond, the yield that is, and the 2-hour chart and the 10-year yield. If they pop, the XHB will flush down despite the bull flag pattern. We'll look at the IYR real estate. This is what the retail mom and pops are buying. Looks pretty good right now. We can argue that it is a bull flag. We can argue it is inverse, head and shoulder, sure. But if bond yields move higher again, it's going to flush down, folks. There is no doubt about it here. If we look at the XLU daily chart, we got above the Bollinger Bands, got a pullback. We're now at the support of the 20 days moving average and the trend line in yellow. We break that, we got more downside, would be a confirmation that bond yields are going higher. But not all yield-sensitive sectors are behaving the same way. For example, the XLP daily chart for staples looks a lot better than the XLU, looks a lot better than IYR. And we talked about this before. Dividend investors already got out of these names. Out of Procter & Gamble, out of Coca-Cola, out of PepsiCo, out of General Mills, out of Mondelez. But now we see value investors buying these stocks because consumer staples are getting really cheap. And they happen to be outperformers in a recession-like environment. When the economy slows down, these kind of companies outperform. So I would say that when you buy any ETF or any kind of stocks, betting that bond yields will go down, you gotta be selective here. You gotta avoid the cyclicals, such as the home builders. These companies rely on a really hot economy. Maybe pick stocks that rely on a weaker and a slowed down environment, such as staples. When we look at the VIX 4-hour chart, what do we see here? We were anticipating a pop. We got a pop on Thursday. The entirety of the pop was erased on Friday. What is the message here? You see the flush down in the VIX all along? What is that? This happens when you have traders closing their puts with 30 days plus till expiration. So we have a lot of puts that were closed, and the VIX almost bottomed. Comes Thursday with the bomb in the 30-year auction, and the commentary by Powell, and we see demand for buying puts again. We see a pop in the VIX. Comes Friday and we see the mechanical squeeze, and the traders closed their puts. They capitulated and closed their puts right away. So we see the VIX going down, but not breaking support at 14.13. What does that mean? If there is a catalyst next week, be it the CPI or otherwise, that would prompt the equities market to buy puts, could be because of Moody's downgrade. If that happens, then we will see the VIX recovering. And in my book, if we keep 14.13 as support, the most likely scenario is the VIX will be bought, puts will see some demand, and we'll be moving back to the 17 line again. So next week will be really important from a volatility index perspective alone. If we look at the Big Kahuna Apple hourly chart, what do we see here? Steep rally, positioning, short covering, algorithms buying. They buy the largest name in any ETF despite the fundamentals. The report was bad, but we continue to see buying and accumulation here. Is it becoming too excessive? The answer is yes. But we could have said that Thursday. We could have said that Wednesday. Of course, now it's more excessive than before. So getting a pullback here is not out of the ordinary. But we have to look at the upside target here. How far can Apple go? If we use the daily chart, we know that we have a little gap above there, as I'm highlighting here. That could be a target, and it could also coincide with the top of the breakdown candle. But we have a little room in the RSI here in the daily chart before it becomes becomes overbought. So that's doable. Here's the problem though. Even if that is the destination here, we will make a higher high, which is bullish, but it means we're going to go down. Any reaction as a counter reaction, and the counter reaction will get us down to mark a higher low. Now, do we have to go to the gap necessarily here? Of course not. Maybe the top of the Bollinger Bands is good enough. We've seen that before. Every time we traded above the upper Bollinger Bands, we went down. So Apple could have topped right here, and we go down Monday seeking a higher low. Once we get that higher low, then we can talk about whether Apple is a viable opportunity or not. Fundamental-wise, it's not, but technical-wise, it could. If we look at Tesla, the souffle daily chart, what do we see here? On the bullish outlook, suppose the market goes higher from this point on. We see retail capitulation. We see a catch-up trade. The laggards catch up with the winners. Tesla's the laggard. Maybe it's going to catch up here. What is the case for that? Number one, it appears that we closed the gap here and we're keeping 202.5 as support. In other words, we're keeping the inverse head and shoulder pattern alive. All we need is a crossing above the 20 days moving average. We got a confirmation to close the gap above. The momentum indicators support that, be it the MACD, be it the RSI, be it the Vortex. So Tesla looks a little sexy here if you want to play a catch-up trade. What is the counter argument to that? Time. If it doesn't do it in a timely manner, meaning by Monday. If it doesn't happen, then the CPI comes out Tuesday, and Tesla could flush down with the rest of them. Why do we say that? You look at the weekly chart, where the bearish case is. Got a rebound because we got outside of the Bollinger Bands, but now we're within again, and we're forming a bear flag pattern. On the weekly chart, the momentum indicators, be it the RSI, be it the MACD, be it the Vortex, all negative. This is why we say that time is really important for Tesla right now. The pop has to happen by Monday. If it doesn't, then more likely than not, the bearish scenario will take place. How about Nvidia? Daily chart, what do we see here? We talked about the head and shoulder. It was supposed to play out, almost did, but then we got the reversal because the market became mechanical, not technical in nature. But now what do we see? We're above a sloping line of resistance, number one. We're above the prior high, so we have a higher high. All of these are bullish indicators, not bearish. On the other hand, we know that we're also outside of the Bollinger Bands. And every time we traded outside of the Bollinger Bands, in this case the upper Bollinger Bands, we got a pullback. Likewise, we look at the RSI, we're almost getting really overbought here. So the risk for a pullback is highly likely. But since we have made a higher high, we're looking for a higher low. Could that be at the sloping line? That's a possibility. Could it be at 440 or the 20 days moving average? That is another possibility. What you want to see is when this pullback happens, you don't want to go too low here. And it shouldn't happen because a fundamental catalyst. Because a fundamental catalyst, like the CPI, for example, or earnings, are the reason why Nvidia went down, then we could see a violation of the 20 days moving average. And if that happens, then the risk of revisiting the low becomes highly likely. But for now, the garden variety says we pull back and form a higher low. Lastly, tulips, Bitcoin. And this time we're using a weekly chart because the daily is not offering any new information really. But on the weekly chart, the argument says, look at the RSI, it's really overbought. But we're trading outside of the Bollinger Bands in the weekly stand. And that's not good. It means that this is really excessive. We're due for a pullback. On the other hand, you look at this example where we traded outside of the Bollinger Bands and we kept going higher and higher and higher. And the RSI was pushed higher and higher and higher. Could this breakout be similar to the breakout in Q4 in 2020? That is a possibility. But understand this. Back then, the circumstances, the sentiment, the bubble, the participation by the retail mom and pop was different. So how do we know? You watch the volume. If the volume increases, then sure, maybe we have a stampede episode as we've seen in Q4 2020. And Bitcoin defies any boundaries. But if the volume doesn't increase, then the likelihood would be that this is going to be similar to Q4 2021. We saw a top in Bitcoin and then we saw it going down. So the volume is now the key, whether this is going to be a breakout in Bitcoin or a false breakout, and down we go again. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday the 13th, we have Governor Lisa Cook speaking and the monthly U.S. federal budget. Not a lot here, which could be a day, if we pass this Moody downgrade, could be another day to add more gains here. But then comes November 14th, Tuesday. We have a bunch of Fed zombies speaking from New York, John Williams, Vice Chair Jefferson, Vice Chair Barr. From Chicago, we have another zombie, Austin Goolsbee. Of course, in regular days, their commentary wouldn't matter. But on Tuesday the 14th, it would matter because we have the Consumer Price Index, the CPI, aka the CPLI. And it comes along with the NFIB Optimism Index for small businesses. And Wednesday, the 15th, we have the Producer Price Index, the PPI, along with retail sales, along with the Empire State Manufacturing Survey, on top of business inventories and a bunch of Fed zombies, round number 2, from New York, John Williams, Michael Barr again, and this time around, Richmond Fed President Thomas Barkin. If we look at Thursday, November 16th, more Fed zombies speaking. Michael Barr is in a role. He's just speaking all day long, all week long. Then we got Governor Waller and again Governor Lisa Cook. But we also have in the macro front, initial jobless claims, the import price index, the Philadelphia Fed Manufacturing Survey, industrial production, capacity utilization, on top of home builders confidence index. Friday the 17th, we have housing starts, building permits. We have a bunch of Fed zombies speaking. Suzanne Collins, Michael Barr again. Give the guy a break. Chicago Fed President Austin Goolsbee and San Francisco zombie President Daley. And of course, we have options expiration on Friday. Heavy week. The week that was a nothing burger. Very little obstacles. The path of least resistance is higher. But boy, next week, it's gonna be heavy. We'll be active, folks, here on Discord, all over the place. So if you enjoyed the video, press the like button, subscribe, leave a comment, and consider joining us as a member. Become a Maverick member, or you got a problem, and that's yours. But folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. Good night.
Now, you're not naive enough to think we're living in a democracy, are you, buddy? It's the free market. And you're part of it. Yeah. You got that killer instinct. Stick around, pal. I still got a lot to teach you.